So what is financial planning? I think the quote on the screen is a quote we've used a few times before because I think it provides some great context and a great overview. It comes from the FPA of Minnesota. That's the Financial Planning Association Minnesota chapter. But as I was reading this slide, getting ready for today, I thought another maybe more direct way to say this is that financial planning is really just the process of looking at your finances today and making a plan to get them where you want them to be. And in both definitions, I think the word process is important because this is really broader and more holistic than any one of the satellite items shown on the slide. It's really the combination of all of those items and getting them to gel and work together, sort of fitting together all the pieces of your financial puzzle. And there are a couple other things I want to note. First, I think financial planning can really be helpful in allowing us or helping us to fight our own instincts. Because generally speaking, most people are not wired to proceed rationally all the time, especially when it comes to money. So having a plan and working that plan and anchoring in that plan can really make a difference. And the second thing I wanted to mention, and I'm sure this seems obvious, but financial planning doesn't happen naturally. It doesn't happen spontaneously on its own. You have to make it happen. And if you need help to make it happen, you have to seek out and get that help so you can get a plan in place and start working that plan. Next up, Allison's going to talk a little bit about budgeting and saving.
And I will mention that when it comes to having a financial plan, most people don't. So if you're sitting there thinking, oh my gosh, everyone is ahead of me, this sounds stressful, I'm so behind, that's not true. Most people don't have a financial plan. The ones that do are very often successful in meeting their outcomes, their goals. And so we want you guys in that category, which is why we're talking about it today. But I get to talk about budgeting, something that I love, but also something that most people hate. I think budgeting and dieting kind of go hand in hand with how much people love them. But budgeting is not intended to be restrictive. If you have a loss of income for some reason, you might have to be a little bit more restrictive for a period of time. But the idea behind a budget is that you name your dollars. You control where your money goes instead of, you're kind of money controlling what your life looks like. And most people are thrilled to see that the wants column of this kind of 3-part budgeting and saving tiered system actually exceeds the savings. So again, we want you to spend some of your money at least while you're alive. I have had, working in this industry, clients pass away a couple weeks before they were planning on retiring or a few months into retirement, which is really sad. So our goal here today isn't to say, don't live your life, stop spending on everything you enjoy to save for retirement. But just to kind of give you some general guidelines as to if you want to meet your financial goals, here's what's typical in terms of how you kind of categorize your expenses. So needs, things like your mortgage payment, rent, food, both groceries and, the things that you truly need to survive, basically, medical expenses, transportation, getting to and from your job, obviously paying for car insurance, all those sorts of things, car payments themselves. And then debt payments, it's if you have a lot of debt, you do need to be making those payments to avoid other negative financial consequences. So that typically makes up about 50% of a person's total budget. And we'll talk in a little bit about what some of those large categories are and where you have some control in monitoring and changing those expenses potentially. And then wants, 30%. So again, that's even more than savings. In the retirement industry, we say you should be saving between 10 and 15% of your income in some sort of retirement account, including what your company puts in for you if you have an employer-sponsored account. So it doesn't all have to come from you, which is extra great. So that additional amount up having an emergency fund, looking at having at least 3 months of expenses set aside if you are in a joint income situation, or at least 6+ if you are, a single income household. But kind of setting aside those categories. The best way to get started with budgeting isn't to initially decide, how you want to categorize, but to just track what you're already doing. Many of you, if you just track for a month or two, might find that you're already within these percentages, and then you're going to feel really great about what you're doing. Other people might find that they are able to make tweaks after tracking it, or realizing, I like to give this example a lot. I love those, year-end holiday Hallmark movies. I know they're cheesy. I like the predictability. So 2 years in a row, I've signed up for it and then forgotten to cancel it for a few months. So tracking those sorts of expenses allows you to see where you might have some leaks, essentially. And when you plug those leaks, when you pay attention to your spending, it does give you more control and more flexibility in the future. So again, you have the amount of money that you have, regardless of whether you're tracking it or not. We know it can sound restrictive, but just tracking it and finding out kind of your own patterns. There's a lot of tools that you can use to do that now too, so you're not having to do it manually. A lot of different software that will link accounts to kind of give you a better picture. We just recommend starting there with tracking and then work slowly over time. Making big changes all at once isn't always sustainable. So slowly over time to kind of shift into these ideal percentages. I mentioned that needs category has a few large expenses. Obviously, housing and transportation account for the largest share. Some people love having a really nice car, don't mind having a car payment, can afford it. Absolutely nothing wrong with that. We're not assigning moral value to these sorts of items. But if you don't really care that much and you have different goals, you want to travel more, it's not something that's important to you, buying a used car gives you a significant savings each month that you can devote elsewhere. So our goal is for you to be intentional about the decisions, the spending decisions that you're making, which again starts with tracking. But obviously, any sort of change that you make in housing or transportation because of the large dollar amounts involved can have a huge impact on your overall kind of financial goals in the future. Every dollar spent today is one that you're not saving today. Every dollar saved today is going to have a bigger impact on your overall savings in retirement specifically. So that's kind of the lens that I'm focusing on. But just think about the things that you can control. And again, the larger items are going to have a bigger impact if you're able to make adjustments. So that I mentioned, my lens is obviously retirement. Jon works in exit planning, so I help people get to the point where they can exit their business or just leave employment. Again, my goal is for everyone to be able to retire at the age that they want to, but hopefully love their employer enough that they, stick around, but ultimately having the flexibility to leave at any time because they've done a good job saving. So there are lots of different types of accounts. At your particular practice, you may have a 401k or you may not. You may have an employer sponsored IRA, or you may have your own IRA that you contribute to because your employer doesn't offer anything. There's so many different kind of working scenarios that people have. So we like to kind of provide this hierarchy. What order should you, defined very loosely, consider contributing if retirement savings is really your goal? So if your company offers or you have the ability to participate in a 401k, they have the highest limits of all the types of accounts, meaning they have the most tax advantage available. Most 401k plans or 403b plans too, they will offer a match or a company contribution in the form of profit sharing. So typically it's wise to participate in them, especially if there's a match, to at least get that company money. Sometimes you're getting 100% return on investment. There's no other guarantee like that in the investment world. So we recommend at least contributing enough to get the full match. But if you're looking for additional tax savings, it's also fantastic. The limits for this year, if you are under 50, you can put up to $23,500. If you're over 50, you can put an additional $7,500 in. And then if you're between 60 and 63, this is new for this year, you can put up to 34,250 in. So an additional catch up of 11,250. So that's a new provision in 2025, allowing, again, 60 to 63, very specific window of aged employees can contribute even more to their plan. So again, very high limits, great opportunities for tax deductions. You have Roth and pre-tax options typically. And then for those of you who may be ineligible to contribute to a Roth IRA due to income limit restrictions, because there are limits on that, anyone can contribute to a Roth 401k. So if your 401k plan has the Roth feature, which again, a majority of them do, that's also a great opportunity to not save on taxes now, but save in the future. If anyone has questions on that, you can always reach out. I'm not going to go into a whole lesson on that too. But then once you've either gotten the full match, or if you kind of have some other goals, you want maybe like slightly more easy access to the funds. 401ks are pretty strict when it comes to distributions. Then you consider contributing to an IRA. Or if you don't have a 401k available through work, if you have an employer-sponsored IRA, they do have slightly higher limits. So that's a great option too. But traditional IRA limit, $7,000 with an $8,000, or sorry, a $1,000 catch-up if you are over 50. So 50 is that magic catch-up age. Very similar rules to 401k, but again, slightly increased access, slightly nicer rules once you get to 73 too, in terms of distributions and some charitable options. So that's also great. It's great to have multiple vehicles too, so you have some flexibility throughout your career and in retirement. An HSA is only available to those who have a high deductible health plan. The limits are also high, and it's a tax advantage account. So if you use it for medical spending, that money does not get taxed. Then it basically turns into a traditional retirement account once you get to retirement. So then you can take out the funds for any reason, which is a fantastic option. It's just another, again, type of account way that we're all going to have lots of medical expenses in retirement too. So that's another good vehicle to fund. And most people are already doing that, not even necessarily thinking of it for retirement, thinking of it for kind of current expenses. But it's a great option. You can invest it for the future as well. And then there's taxable brokerage accounts. So in these, you use after-tax dollars. You know, you've already gotten paid. It hasn't impacted your paycheck. You're taking money out of your bank account. You're funding one of these types of accounts. You have full flexibility. You can take distributions out at any time, but you can also invest them very flexibly. You can have them in the market. You can have them in crypto. You know, whatever kind of floats your boat. You can have long-term goals, short-term. Again, we're looking at this from a retirement perspective, which is why we have this at the bottom of the hierarchy. But if you have different goals, if you're saving for a down payment on your house, you know, things like that, you're obviously not going to start in your 401k for that. So just know that the lens for this is retirement savings, and that's why we have taxable brokerage at the bottom. Sometimes with certain people, if your money is too easy to access, it's never going to be there for you in retirement. So this is definitely, we recommend this if you're already kind of funding the other vehicles. But, you know, it gives you tax diversity too. This isn't taxed the same way as regular income is. It's taxed based on capital gains. So it just gives you a little bit more flexibility with how you take distributions in retirement. It does give you access to it while you're still working too, which is a little bit different than the other types of accounts. And then one trend that I'm seeing, and you know, I'm almost 40, so it's easy for me to talk about retirement and it doesn't really feel real to me yet. So I'm sure that it will get harder and harder to practice what I preach as I get closer to retirement. But what we're starting to see is that a lot of people invest as if they're going to spend their entire retirement account the day that they retire. So I just want to remind you, especially with Jon's comment on financial planning, our financial planners use a very soft term to describe when you pass away, and they say it's the end of plan. So your retirement account is intended to last through the end of your plan. The retirement date is a very important date in that trajectory, but it is not the end-all be-all date. For most of you, when you retire, your account will still be a long-term account even at your retirement date. So we encourage, you know, investors to not get too conservative when it comes to their investments too quickly. You'll see on this chart the target retirement date, whatever age that is for you. We still recommend being at least 60+% in stocks. That feels really uncomfortable to a lot of people. It still subjects your account to some market risk. Things have been really volatile the last couple of years, still really positive, but there's been a lot of, you know, good days and bad days. But the important thing to note is you're not going to spend your whole balance on the day that you retire. You still have plenty of time for that to grow. There are strategies that we can employ. You can work with a financial plan to determine how much do you need to set aside, and maybe, you know, something safer to cover the next 2 years of expenses in case markets were to go down, to allow the rest of your account to rebound. So there's a lot of strategies, but ultimately, when you get to that point where you feel like you might want to make an emotional move to being a little bit more conservative, maybe ahead of this actual timeline that we've shown here, that's a great time to, you know, reach out to someone who works in the industry. You know, will benefit you to learn to tolerate a little bit more risk than you might be naturally comfortable with. As Jon mentioned, when it comes to our money, we don't always make rational decisions. We're very emotionally attached, especially the larger that account gets. But it always helps to talk to someone who does this day in and day out. And I haven't personally experienced retirement, but I've worked with thousands of retirees. So, right. And then education planning. So the cost of education continues to increase. Once you know, I think the oxygen mask is used, you know, too often, probably, analogy, but basically you're all familiar with it. You know, if the plane's going down in the oxygen masks, or if the cabin pressure drops, oxygen masks drop, you're supposed to put yours on before you put it on your kids. People to kind of at least consider that stance too when it comes to saving for retirement. You know, young people, if they start saving, they have a ton of time. The younger you start saving, it can have a significant impact on your retirement balance. So your kids are going to have a lot of time to be able to invest. And you know, time obviously is finite. We're losing it every day. So we want you to be able to think about and plan for your college education expenses for your children if that's something that's important to you, but make sure you're also saving for yourself in retirement accounts as well. So when it comes to the kind of two main accounts that we see, and we do actually see people using Roth IRAs too, so I'll just mention that as an aside before I cover the next two. But the two most common types of accounts that we see are 529 plans. Those are state run. They allow tax-free distributions for qualified education expenses. And if you take money out for non-educational reasons, it is taxed with a 10% penalty. So these used to be really attractive, especially for people who were 100% certain that their kids were going to school. But I don't know, sometimes I started one for my son when he was like 2, and I have no idea what he's going to do. He's 10 now. I don't know if he'll go to college or not. So the Secure Act created a new option where, as long as the account has been held for 15 years, that money can transition to a Roth IRA instead. So it does allow for it to basically transition to a retirement account for that child if they decide not to do some sort of, you know, traditional schooling. And it is available for trade schools and different vocational programs as well. So the list of qualified education expenses has grown over time as to what's included, but that is now a much more attractive option. In addition, there's no federal tax deduction for contributing to these, but different states have different programs. So Minnesota, as an example, does offer a state tax deduction for investing in a 529 plan. Then there's the custodial account, so a Uniform Gifts or Uniform Transfer to Minors Act. This is fully flexible, so these accounts are created and established for the benefit of a beneficiary. You can use the funds for any reason as long as it benefits the child, and then they get control of it at the age of majority, which in Minnesota is generally 21. Certain accounts are set up with it at 18 during the setup process, though. So that's an option as well. That just functions more like a savings account. So those are what we typically see. And then people will also set up Roth IRAs because you can take out from your basis tax-free to use for education expenses. So that's an option too. Again, we want you to save for retirement in your accounts and use the money for those purposes. But these are two options, especially with the tax savings in the 529 plan, that are really attractive when you're starting to save for your kids.
Now we're going to shift gears a little bit, and we're going to talk a little bit about exit planning. And I think this topic can be helpful and interesting for anyone, but it's generally directed at practice owners or anyone who might someday be a practice owner. And even before we dive in, I want to say that the main takeaway from this entire section of the presentation really should be: the sooner you start thinking about this, talking about this, planning for it, the more options and planning opportunities you're going to have. And that's from a variety of perspectives, right? Tax mitigation, estate planning, financial planning, and even we'll talk a little bit about personal planning, sort of picturing your life after you exit the practice. So turning to the slide, as you can see, the primary reason to start considering exit planning is that your ownership in your veterinary practice is likely your most valuable asset. It's also complicated and illiquid, at least compared to investments in the public markets. So it's going to take more thought, more time, more effort to convert this asset into more liquid cash or other investments that you can use in your day-to-day life. Next on the slide, we're trying to give you a very broad sense of what exit planning means. And in very short, it's really just a term designed to encapsulate the need to plan and prepare so that you can maximize the value of your practice and try to get that maximum value when you sell. And frankly, and it's on the slide too, just as importantly, exit planning should make that transition, make that transaction as smooth as it can be. And for most folks, that's not just smooth for you, the seller, but also for everybody who works at the practice and for your patients. Just trying to make that process as smooth and achieve the maximum value you can. And we always tell people that when you think about how you might prepare a practice for sale, it's really key to remember that exit planning is really just good business strategy. What you do to plan and prepare for an exit, for a sale, for some transaction, and how you get the practice in the best shape possible for that is essentially what you should be doing day in and day out on the business side to run a successful practice, excuse me. Finally, on the slide, I want to talk a little bit about timing and when you should start really digging in and thinking about exit planning. Folks in our industry really love to say you should start exit planning 3 to 5 years before you exit. And that's what we have on our slide, and we agree with that. That's a great idea if you can do it. But the end of the sentence is really a nod to reality, because in reality, it often happens on a much shorter time frame. If we can get it, and we're always trying to educate our clients and folks in the industry, we love to have at least 12 to 18 months to prepare for an exit. That allows for a variety of planning options that may not be available as you get closer to or even into a transaction. But there are also things that can be done on a shorter time frame, including financial planning. So ultimately, the takeaway is what I said earlier, basically. You want to start thinking about this sooner rather than later. But remember, it's never too late. If you've got something in the near term, there is still planning that can be done to try to optimize that exit to the best possible. So for the next few slides, we want to talk through a hypothetical practice sale. And we've set it up and we've titled it as a hypothetical sale to private equity. That's mostly because, as you undoubtedly have heard or know, private equity is and has been for some time playing a fairly large role in the veterinary industry. And we've had some experience with this sort of deal in the last years. I will say that we have seen a little bit of a dip in this activity since earlier this year and last year. But that kind of lull has occurred before, right? And it's been followed by strong private equity interest in the industry. So we'll see where that goes. That's a little tricky to predict. So how have we heard and seen these offers happening? You see on your screen, in our experience, this sort of offer can really come at any time. Sometimes they're solicited, and sometimes they seem to come completely cold. And to our minds, what that suggests, the takeaway from that is you may want to thinking and planning for how you might handle that sort of offer. And if you'd be interested, if you'd be receptive to something like that, how you might best position your practice to receive that sort of offer. Second, generally, when we get involved with folks involved in a potential private equity transaction, or really any sort of exit transaction, the first question we ask, the first thing we try to nail down is who is on your team. And generally speaking, we consider the core team to be an attorney. And there are lots of types of lawyers out there. In this case, we're specifically talking about a transaction specialist with private equity and veterinary experience, if possible. Second person on the team would be an accountant. Again, with that same experience, if possible, transaction, PE, and veterinary experience, if you can get it. And then third, someone like us, a financial advisor. And beyond those three core members of the team, there are a whole universe of other folks that might be needed. Some examples are an estate planning lawyer, an M&A guy, potentially a sell-side broker, and a whole universe of consultants that could be engaged in appropriate situations to help with a business. But again, generally the lawyer, accountant, and financial advisor are the core that either people, when they come to us, already have some of that in place, or if they don't, we want them to try to identify and engage people in those positions pretty quickly. Now, in terms of how that team operates, as you might expect, we want to see some coordination, including someone looking at the bigger picture. To use another overused metaphor, we like to see a quarterback. It's overused because it helps people to get what we're going for here. Someone who is not losing the forest for the trees. And folks like us, financial advisors, will often play that role, among other reasons, because generally your financial advisor will remain engaged with you, potentially before, during, and after the transaction. And sometimes we'll see a CPA do this. Occasionally it's a business lawyer or other lawyer. But generally speaking, it should be someone on your team who is not just engaged for the transaction. In other words, someone who you're going to be working with potentially before, during, and after. And our suggestion, and why I'm really spending a decent amount of time on this team, is we think you ought to really start thinking about building this team and start meeting with some folks in these arenas sooner rather than later. It doesn't mean you have to do anything or even engage anybody, but if you think a private equity sale, other form of sale, or really any exit transaction is on the horizon, or even just over the horizon, it's worth taking the time to start to meet some of these folks, start to meet some of these advisors, so you know what's out there, so you can find a good fit for you. And I would say particularly in our space, in the financial advisor realm, because again, that's someone who, if you engage the right person, will be with you before, during, and after your transaction, and really help plan for your life after you exit the business. So this slide is really the meat of our hypothetical. It's designed to give you a sense of how a private equity transaction might play out from a cash flow perspective. A few things, as Nicole mentioned, I used to practice law, but I don't practice law anymore, so we're not giving any legal advice. Also, we're not accountants. We don't give tax advice. This is all hypothetical. I also want to note that these numbers are made up. 20 million is a nice round number, but it doesn't indicate anything about the current market or, of course, the value of any practice. And finally, as I'm sure you're aware, taxes and other liabilities are going to be very, very specific to your situation. And the idea here is not to try to calculate that to the dollar, but instead just to give you a sense of the possible scale of your tax and other liabilities at a sale. Basically, I want to show you how that top line number is not going to be what you put in your pocket, and how you might want to think about and plan around that idea as you're entering an exit and as you're fielding offers. So walking through the slide, first, as I mentioned, the top line number, the sale number on the slide is $20 million. But in most private equity transactions, certainly in every one we've seen, a portion of that sale number is paid in rollover equity. And here we've pegged that at 25%, so that's $5 million. And that's in the general neighborhood of some of the deals we've seen. So here the cash taken by the seller is 75%, or $15 million. And stepping back before we go any further, what is rollover equity? And I think you could talk about this for a long time, but essentially that 25% is reinvested in the acquiring private equity entity. So the seller of this hypothetical practice now owns a stake in that entity and can participate in any upside appreciation, if there is any, generally when the PE firm exits the investment. Now, I will say from our perspective, when we're doing financial planning with our clients, we generally do not include this rollover equity interest in the planning we do. To our minds, there's not really a great way to value those interests. They have value, there's no doubt, and maybe a lot of value. But we're a little bit conservative, so we generally do not include that in our financial planning. Now, other advisors may take a different approach there, and different, reasonable minds can disagree there. But generally, that has been our approach. And one last quick note on the rollover equity, you can see it there on your screen. But generally, at least initially, this is held in the seller's business entity. So the LLC or S Corp or whatever that entity may be. This rollover equity is held there and not individually by the seller. Moving along in the slide towards the 75% cash position, the $15 million. The first thing you see to the far left are what we'll consider practice liabilities. And that can take a lot of forms. Here in this example, we're putting construction loans, practice loans, and we've seen this many times, there may be retention bonuses or other dollars paid to staff as part of the transaction. And that's, staff is non-owner vets, vet techs, other staff, whoever that may be. And here in the example, we've ballparked all of that, mostly for easy numbers, at $3 million. And so now you're down to $12 million in cash. You see that sort of in the middle of the screen. And now you're talking taxes. And the first tax item that I want to talk a little bit about is pass-through entity tax, PTE tax. And of course, this depends a little bit on what sort of business entity is being used by the seller. But generally, we've seen pass-through entities, think as I mentioned earlier, S Corps or LLCs for veterinary practices. And in those cases, the pass-through entity tax is generally paid by and through the entity and not personally by the owners. And, depending on the timing of the transaction, when it happens in the year, you may not make the bulk of that pass-through entity tax payment for months after the transaction closes. But generally, and we work with folks, accountants, to get this all figured out, generally that amount needs to be calculated and those funds need to be reserved because you want that money to be there when the tax bill comes due. Now, that doesn't mean you can't make any return on those dollars while you have them, because it can be meaningful money. As you see here in our example, it's 1.4 million. And if you're working with an advisor, they should have a plan to make some return on those dollars while you have them. But it does mean you likely want to be conservative, because when that tax bill comes due, you don't want to have empty pockets. Moving along in the slide, now you've calculated and set aside for your PTE tax. Again, in the example, we've got that made up number of 1.4 million. Now you can distribute funds to the owners. And note here, after starting with a $20 million sale price, top line number, we're distributing a bit more than half, $10.6 million to the owners. And now you're paying more taxes. Now you're looking at federal and Minnesota state tax. And these taxes are paid generally by the owners personally. And you'll notice in the example that the federal tax number is a much bigger number than the Minnesota state tax. And that's because of the way we're handling PTE tax in this example. And we often coordinate with CPAs on the amounts and the timing and how to handle these payments. But that proportion is, generally speaking, similar to some of the deals we've seen. And again, on the federal tax, just like with the PTE tax, you may not make the bulk of these payments for some time. If you close a transaction early in the year, you may make estimated tax payments based on your prior year income, and you may end up having a very large balloon tax payment the following April. So you may have time with these funds, but again, you want to be conservative. You want to understand what you're going to owe. You want to do that calculation and in coordination with your accountant and your advisor. And you can make return on the dollars, but again, you want to be conservative. So when the bill comes due, you have the money there to get it paid. And finally, at the end of this hypothetical, you see at the bottom, after-tax net cash proceeds for the owners. And in this hypothetical, that's $8.5 million. Now, that's still a lot of money, no question. But what we want you to notice here is that it's less than 50% of that top line number. So it's something to think about when you're going into a sale. It's something to start to, as I said before, plan around, talk about with your advisors, because you really do want to have a plan for how to handle those proceeds when they're received. And that really segues to our next slide. You've seen on the prior slide a hypothetical cash flow from a sale. So now I want to spend a little bit of time talking about planning for once the sale closes. And at this point in the process, we're generally thinking about planning in two categories. The first is personal planning. And this is really about you, right? This is what you want your life to look like after you exit your practice. And as a financial advisor, we can ask questions. We act as a sounding board. We're trying to help you wrap your arms around this. but really, ultimately, the answers here have to come from you and your family. And sometimes that can be a difficult, an effort and time intensive process. So it's something you want to start thinking about. If you've got an exit on the horizon, if you think, hey, it's not, it's a ways out, still, this can be something to think about. Hey, what am I going to do when I don't own the business, when I'm not practicing? Because this is something that really takes time, like I said, and can be something you really have to talk through with your family members. Next is personal financial in terms of planning. And this is really where folks like us, financial advisors, work with you to plan to use the dollars and investments you have to meet those personal goals and to support that lifestyle you want to lead after your sale. And this is really the process I alluded to right at the beginning of the presentation. It's in depth. It tries to see the forest and not just the trees. It tries to fit all the pieces together. And we will often try to build it around a structure of your needs, your wants, and your wishes for your time after you exit or your retirement. And the final thing on this slide is timing. And the slide really says it all. I'm not going to add too much here. Best case, we get some financial planning done before an exit. Still very good during or after. The only real problem can be no planning at all. And again, this kind of goes back to what we talked about at the beginning of the presentation. For most folks, this is the largest financial event of their lives. Exiting and selling their business is the largest financial event of their lives. And of course, it can go right without planning. That happens. But for most people, it's not a situation where they want to roll the dice. Most people want some help and want to get a plan down so that they can see what things are going to look like. They can work the plan over time, and they have somebody who's helping them to do all that. So this slide we generally use when we are talking about financial planning. We included it today just to give you a sense of some of the general benefits and some of the issues surrounding financial planning. What I would add here in an exit planning context is that the nature and enormity of the moment when you sell your practice is such that it really magnifies some of these benefits, right? And if you on the flip side, if you decide not to do any financial planning, I think it also magnifies some of the potential consequences of that choice, just because the moment is really a big financial moment for most folks. Now, this slide is just designed to give you a sense of some of the detail we can get into when we are putting together a financial plan and sort of the scenarios and results and metrics we can get to help guide people. And as I mentioned before, and you'll see on the screen here, we generally bucket items into needs, wants, and wishes. And that may, sometimes that sounds silly or simplistic, but it really can be an effective construct and an effective technique to help people get their priorities in line, to think about their priorities, to help people envision, hey, what do I need? What do I really want to do? And what do I wish that I could do when I exit and or retire? So it's helpful from a planning perspective, and it kind of gets the wheels turning on the personal planning dovetailing with the financial planning. And the only other point I really want to make here with this slide is that any financial planning you do should be dynamic. It should be updated. It should adjust to what's actually happening in your life. And, we regularly will create a financial plan with folks when we get started. And what you don't want to do, what doesn't help, is to never look at it again, to never use it again as a guide. Things change, and it's really impossible to predict how things are going to look, even 5 years out, let alone the 30 or 40 years out that a lot of financial plans are trying to plan for. So when you put together that financial plan, you and the folks you're working with really need to keep it dynamic. There needs to be communication. You need to be talking and tuned into what you're actually doing and what's happening in your life so the plan can be adjusted, updated, needs, wishes, wants might change. All that stuff needs to be open for discussion and changed as your goals and your life change. Because otherwise it's just a static document and it has a lot less utility. Finally, we're going to switch gears again and talk very briefly about estate planning. This is really a critical component when you think about financial planning and planning for your future. So we don't want to leave it out. And the first question we often get or people have is, why do I need an estate plan? It costs money, it costs time. Why do I need to bother with this? And you can see on the screen a list of some of the objectives on the left of the screen there. But what we see and what we think is that this really boils down to a few critical reasons. And the first is control. Most people want to have a say in what's going to happen to them if they become incapacitated or disabled. And they want to have some control over what's going to happen to their children and their assets when they die. Because, if you don't have an estate plan, if you haven't asserted some control over these situations, something's still going to happen, right? I mean, the government will step in, and there are laws that direct the government on how to handle this, and either arrange for your care, arrange to have your children taken care of, and distribute your assets. That can happen without you exerting any control. But most folks don't want it to go that way. Most folks want to have some control over these processes and what might happen either to them, their children, their assets. So an estate plan really allows you to assert some control. The second main item, the second reason we think people might want to consider an estate plan is privacy. Many people want to keep their estate process as private as possible. And there are ways to increase privacy with an estate plan. And very generally speaking, the idea there is to avoid the probate courts as much as possible. Because like most court processes, the probate court is a public process. And so if you're crafting an estate plan with privacy in mind, you want to tend to have items or planning that will help you to avoid probate. The third big reason I'm going to call asset protection and tax mitigation. And in some cases, if an estate is large enough, then there is some planning that needs to be done to mitigate taxes. And that's most prominently estate taxes. Now, of course, we think everyone needs an estate plan regardless of the size or complexity of their estates and needs to engage with an estate planning lawyer to get something together. But it's worth noting, particularly in Minnesota, because of the way some of our Minnesota estate tax and laws are structured, a plan to mitigate Minnesota estate tax is really necessary for more people than most people think. And, tying it back to exit planning, in cases where folks are exiting a business, the need to do some estate planning and the likely need to try to mitigate estate taxes often becomes even more important, even more pressing. Now, looking back at the slide, you can also see a list of some common estate planning documents there on the right side of the screen. I'm not going to go through them all, and this is just a sampling. There are many, 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 many more estate planning vehicles that an estate planning lawyer might recommend. But the idea here is, excuse me, when you have a conversation with an estate planning lawyer, you should ask them about some of these and see how they think your plan should be structured. And feel free to raise these particular ones and say, hey, do you think this does or doesn't make sense? What do you think? How would you structure my plan given my particular situation? And I will say we don't, as I mentioned, practice law at Trust Point. We don't draft any of these documents for our clients, but we do have a lot of former attorneys and CPAs on our team. So we do review them sometimes and sometimes give our clients ideas about how to talk to their lawyers. And if you don't have anything together yet, first, that's like a lot of people. The majority of folks probably don't have something together yet. But if you don't have anything together yet, we do know a lot of estate planning lawyers that we work with regularly. So if you're thinking you need to get this done and sort of add it to the, if you're anything like me, the unending and ever-growing to-do list, if you're looking for a referral or recommendation, please do reach out and we can get you a few possibilities so that you can get what I think really is an important process, some important documentation, some important advice, that process started. And I think we're coming close to the end of time, so we're on our final thoughts slide. And before we take a look at it, I just want to say thank you all so much for joining us today. We really hope the conversation has been informative and helpful.